Greetings, my name is Kevin Matthews and I am the tax professor. Class is still in session because the learning never stops. I want to say thank you very much for coming to the video today. Today we're going to talk about something called involuntary conversions and what would happen, to any tax consequences as a result of having to replace some property. And guys, look, I've lived in all sorts of environments. I mean, I've lived in deserts. I've lived in Tornado Valley. I've lived in Japan, probably the most seismic, active piece of real estate on the planet. I've lived in Florida for hurricanes. I mean, and it's kind of actually a very interesting thing. I lived here in the Washington, D.C. metro area when they had, Hurricane Sandy that blew up towards the coast. I mean, we were feeling effects of it. I mean, obviously not to the level that the guys on the coast were, but we've also had earthquake. We actually had an earthquake while I was here, and so I found it kind of interesting, having lived in Japan, gone through a few earthquakes. I've actually been relatively close to a nuclear accident, which it was interesting. Not Fukushima, but there was actually another one that was in the Chiba prefecture at the time that I was there, where some guy was pouring nitric acid in a way that he wasn't supposed to, and ended up unfortunately killing himself and another guy, and then causing a lot of damage. So we call these, in the tax world, we call these acts of God. And so it's sort of the thing that they say, basically it's not something that any one person can control or to deal with in that sense. So it's, sort of if you have an act of God that happens to you, I mean, it's not like you sat there and said, gosh, I really don't like this house anymore. I wish a hurricane would come by and just sweep it away so I can go build a new house. Most people aren't like that. At least I hope not. But for the truth of the matter is that when acts of God take place, it's a very devastating thing. And to have a situation where they say, hey, look, your house was destroyed. You've got insurance proceeds. You're going to buy a new house. Oh, by the way, we're going to call that a taxable event. It kind of doesn't make good public policy, and so Congress wisely actually added some provisions into the tax code that allow them to defer the gain that they would have seen otherwise, provided that an act of God kind of took place. And I use the term act of God. That's usually when we're talking about these things. But the government taking your land for personal or for public use is another one. Where they basically come in, eminent domain. They're going to come in. They're going to take your house and say, hey, look, yeah, we need this land for, building of a bridge, building of a railroad system, or something of that nature, that they say, look, we need it, we're going to take it, and by the way, we're going to compensate you fair market value as we are required to under the Constitution. However, we're taking it. That is still considered an act of God in this case, because you didn't call the federal government up and say, hey, take my house, please. And in that case, it's something that, that obviously it's not something that you've desired to happen, but it happened. Okay, so it says if the property is involuntarily converted into other property, which is similar related use, gain is automatically deferred, but that doesn't happen too often. Normally, the lost property is converted into cash or other property, which isn't similar related use. In those situations, it's recognized and taxable. So, for example, my house gets destroyed because of one of the hurricanes that I actually am a survivor of is Katrina. I actually saw the upper bands as I was in the middle of a military move from San Antonio to Jacksonville, Florida, when Katrina hit, and luckily my wife and I made it to the bridge on time. So trust me, I get how serious Katrina is. But say I'm one of those Katrina survivors that had their house completely destroyed, and the insurance company comes to us and says, well, okay, Kevin, your $250,000 house, we're going to replace it because obviously it was done. We're going to take a deductible. I think it's like 2% or whatever it is. And then, this is what we're going to pay you in terms of insurance proceeds. If I take the cash and run, I've got a potential taxable gain event. And what's going to happen is that my house is going to be deemed sold on that day, and then I'm going to have to calculate any taxable gains or not. Now, anything that gets you out of the taxable gain, for example, you know, say I've been living in the house for the past 10 years. Maybe I qualify for the home, you know, the 121 exclusion that we've talked about in a previous video. You know, in that case, so it would actually be considered something that you could do. For business or investment property destroyed by a federally declared disaster area, special rules treats any tangible business property as similar or related to use to the property converted. So, I remember in Hurricane Harvey, I mean, they were talking about how, you know, well, actually, not just even Harvey, just any hurricane, you know that certain supplies become very scarce. And as a result of which, what ends up happening is, you know, people just, you know, they're looking for stuff. Well, it's not that people are coming by and buying it. Sometimes it's also destroyed. A very good example is food stocks. I mean, you think about it. If you have a whole bunch of vegetables that are coming into the store and the hurricane comes in, wipes the store out, blows all the vegetables all over the place, even if you could find the vegetables, you wouldn't want to eat any of that stuff. It would get you very ill and all that sort of stuff. So all that, you know, gets wasted. And so as a result of which, you know, the IRS has those rules that they need to follow with that. If you replace the involuntary converted property with property that is similar or related to use within a specified time, you can elect to defer the gain and the tax, of course, on top of it. To qualify for the deferral, the replacement property must be generally purchased within 2 years of the close of the tax year which the gain is realized. 3-year period applies for condemned property. Also, taxpayers can apply to the IRS for an extension for replacement periods. I've never actually had to do one of those before. I have heard of people who have had to do those. I mean, I've never heard the IRS say no, but I mean, I wouldn't want to try to say, I wouldn't want to say this video, oh yeah, don't worry about it, just ask the IRS, there'll be no problems. It's always facts and circumstances. If you've got a realistic reason, I'm sure that the IRS isn't going to have as much of a problem with it. You just need to get your, you know, get somebody to write your letter correctly and make sure that you get your facts in order. If you elect to defer the gain, you have to recognize the gain to the extent the replacement property costs less than the amount that you receive as compensation. So, for example, my house gets destroyed as $250,000. Okay, maybe I bought that house in 2005, back when the real estate prices were really high. I then go out and I say, okay, I'm going to go buy a new house, but I realize that when I do the construction, it only costs $200,000. What the IRS is going to say is, hey, wait a minute, you got $250,000 to replace your property. You go out and you spend $200,000 to build it up again. That $50,000 delta, you're going to have to pay taxes on. And you know, again, there could be some rules to get around that, but again, you want to work with a tax professional that understands all of that and will work on your side. And so, you know, again, an EA, CPA, or tax attorney. Just make sure that you're working with one of those guys. Rules apply to personal property as well as property used in trade or business or held for investment purposes. So if you have a rental property, house gets destroyed, you decide to rebuild based off the proceeds that they give you for the insurance company, you can elect to defer the gain on some of that. Although, I will not lie to you, if you have had a rental property, maybe you've had it for several years, maybe you don't want to elect the gain. To defer the gain. Maybe you've got enough built up passive losses that it makes sense to go ahead and take the gain hit and then go ahead and restart out with new basis. Again, it's something that I think that we all could you know, I think it's something that somebody who's a professional is going to have to take a look at it and say, this is something you want to do, this is what you don't want to do, blah, 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 so on and so forth. And I think it's very important to be able to do that. Well, folks, that's all I got to say about that. I want to say thank you very much for watching the video. My name is Kevin Matthews. I am the tax professor. Class is still in session, so the learning is not going to stop. So if you want to, you can go ahead and you can leave comments in the box below. Or if you want to reach out to me directly, you can go to www.betasolutioncpa.com. That's www.betasolutioncpa.com. Please go ahead and do me a favor, and if you like this video, please hit like. If you really like these videos and you like the series, please hit subscribe. We'd really appreciate it. And thank you very much for watching this video.